Hello and welcome to PQ Prime. A very good afternoon to all the viewers. One stock that is buzzing in trade today is a Metro Brands on the back of the Q4 numbers. Clearly, the stock is up around 5 to 6% in trade. And to discuss more as to what's worked and what's not worked in the quarter and what's in store for the future, joining us is Mr. Nissan Joseph, Chief Executive Officer at Metro Brands. Welcome to the show, Mr. Nissan, Mr. Joseph, and always a pleasure to speak to you.
Thank you, Hero. Thank you. Good to be here.
Always a pleasure. Mr. Joseph, my first question coming to you is a good growth coming in terms of the top line, and the acquisitions and the integrations that we are doing are really helping us well. One thing which has not worked is where we are seeing pressure with regards to where the profitability goes as well as the margin goes. How would you describe the quarter according to you?
Sure. So let me just walk you through a quick couple of highlights, right? So last year we crossed many milestones as a brand, as an industry, as a corporation. We crossed 2,000 crores for the first time. We recorded a 56% year-on-year growth. We also had our highest profit percentage of 18% plus in PAT. So these were quite significant milestones, and more importantly, they fall well within our guidelines that we said we would always run margins somewhere, gross margins somewhere in the 55 to 50%, 57% range. We would run our EBITDA more 30 plus percent and our PAT 15 to 17%. So we're actually quite pleased that we accomplished all of that. We also opened up 115 new stores last year, which across added 10 cities in India. So that's also another great growth for us that we experienced. So overall, we're quite excited about where we are. When you talk about not so good news, I would actually frame that into saying that that was what we expected, and we guided to that when we took on the Cravitex business. We knew that we would have to be rationalizing the distribution points. We would have to be looking at cleaning up the inventory, and we would have to spend and invest money and time into repositioning the brand. So in our mind, all of that worked according to the plan. You're right. It did look like it affected our PAT. However, on a quarterly basis, quarter compared to the previous year's same quarter, our profits were up 20% as a standalone business. Of course, when you throw back the Cravitex acquisition and its impact, it evened it out quite considerably. However, that was still very much within our plan of how we plan to unlock the potential of the Fila brand in India.
Right. So, how are we looking at unlocking the potential there, and where do we see the break even coming in? Because clearly, on the back of the acquisition, the loss has actually reduced the overall profitability on a consolidated basis, right? So, when do we see that, turning into, getting into break even or getting into profitability?
So we anticipated when we acquired the business, late last year, calendar year, that it would take us about 2 to 3 quarters for us to get that position the way we wanted to. You got to look to the future with Fila and say, when you look at its competitive brands in India, those brands run 300-400 stores a piece. And, we all know that sports and wellness is a huge growth category for India. Having said that, coming back to your question, we anticipated it to take 2-3 quarters. We're 1 quarter down. So we are looking at an additional 2 quarters where we believe we will invest. And I look at it as an investment. While it is profit erosive, it is an investment for the future of the brand. However, what we need to point to is the fundamentals of the base of the business for Metro Brands, which is our Metro Mochi, Walkway, Crocs, and FitFlop, are extremely sound. And we haven't taken our eye off the ball in what drives the core of our revenue. We've just made sure that we're investing the right amount into this business so we can unlock its potential in the future, which is tremendous, as I've just identified.
Right. So overall, if you have to break this up between, e-commerce, including omni-channel versus in-store sales, how is the growth panning out, and how much of the contribution now is coming from e-commerce, and how much do we plan to scale it up to?
So we were actually very excited to see a 40% growth last year in our Metro Brands business for the e-commerce space. And I say that because, as you know, last year, the stores all opened back up, right? And brick and mortar shopping was in full force. The consumer came back to shop with a lot of velocity and energy. And we were excited because, we were up 56%. Having said that, it did not seem to retard our e-commerce growth. And that's probably symbolic of the investments we have made in the digital space. Having said all that, e-commerce runs about 8% of our business. It's a number we're comfortable with. As you know, in India, e-commerce can be quite discount-led, and it's a game that we've decided not to play in. So we're very comfortable with the profitability and the positioning of our e-commerce business, and we see no reason why it would not continue to grow in double digits into the future, though the consumer has shown a preference for shopping in person when it comes specifically to footwear.
Right. So overall, how is the average selling price also improving? Because there is a lot of focus that's coming in with regards to premiumization. And that's something that we're looking at Metro as well when we look at the various categories in terms of products being sold. So what's the ASP looking like now? Where do we see it moving? And how do you think it'll benefit our margins?
So the ASP has grown, but I don't want to speak to the ASP because I think that's can be a diluted number because you see a lot of things mixed in that, right? How we measure our premiumization progress is strictly by we look at footwear that we sell over 3,000 rupees, right? We consider that to start to be the base of the premiumization ladder. Our footwear sales north of 3,000 rupees was 40% in the previous year. Last year, it grew to 44%. So when you look at the quantum of growth, we had a 57% growth year on year, and our products over 3,000 rupees so grew by 400 basis points, which went up to 44%. That signifies a big jump in the consumers that are shopping Metro and appreciating the premiumization of the product that they see in our stores.
Right. So overall, Mr. Joseph, clearly, if you see, we've been really aggressive in terms of our store expansion plans. The business model is really good, taking into consideration we are asset light. So there is no major risk that comes in on that front as well. There are great growth opportunities. There is execution capability, and the balance sheet is lean for us as well, right? Now, taking all of these into consideration, what's the kind of CAGR growth that we're anticipating over the next 3 to 4 years?
Well, there are two different questions, right? So I think the first question, let me take the first question, which is the store growth. We feel very optimistic about the future of store growth potential for Metro Brands. We are in 174 cities today, Hero. If you think about the landscape of India, we could easily be in 300 plus cities. So when I look at the runway for growth over the next few years, there's definitely that runway that exists when it comes to cities, that when it comes to high streets and malls that are being built or already have been built, that we can expand our stores into. And don't forget, we have 7 concepts. We have Metro, we have Mochi, Walkway, Crocs, Flip-Flop stores, and now Fila stores that we can expand into all these markets with. So the growth potential for Metro continues to be very strong. As far as our balance sheet goes, we run a very healthy balance sheet. We zeroed debt company for many, many, many years, and we know how that the metrics it takes to operate and open a new store.
Right. And overall, any outlook in terms of FY24 alone?
So, I think we're glad we're over the COVID bumps. Some of those bumps were tough when we went through it. It also created artificial growth numbers this year in some months. Example is January. Last year, January, we had the COVID impact going through different parts of the country. This year, we didn't have it. We're going to see our business go back to being normalized. On a normal basis, Hero, we run an 18% plus CAGR. We have had gross margins that come in at 55 to 57%. We've had EBITDA 30+%, and we have our PAT coming in between 15 and 17%. So when I look at the runway for growth, backdrop that with what we've accomplished, backdrop that with what our numbers show that we're always within those ranges, I feel very optimistic that we could definitely guide towards that kind of growth.
Right. All right, Mr. Joseph, so much for sharing those views and joining us on the show at BQ Prime. Stay safe and speak to you soon again, and good luck for the coming quarters.
Thank you.
Yeah.